That structural risk is compounded by the hyperscaler capital expenditure rate. In 2026 alone, the industry committed a staggering $725 billion to AI infrastructure. The depreciation math on that hardware is unforgiving. To justify a 3 to 5 year lifespan, that investment requires an annual AI revenue growth of $360 to $600 billion. Current revenue falls massively short of that threshold. The largest tech companies have the cash flow to absorb the impending asset impairments, but the massive web of privately valued startups and GPU cloud providers are caught in a highly fragile 1999-style capital bubble. Between the durable fundamentals and the frothy capital sits the contested middle. These are three unresolved market variables that will determine if the upcoming correction stays isolated to startups or infects the broader S&P 500. The first variable is whether the current hyperscaler infrastructure buildout can be economically justified. The bearish argument, advanced by analysts at Sequoia, states that only the arrival of artificial general intelligence can generate enough economic output to cover a projected $5 trillion cumulative data center cost. The bullish dissent counters that AGI is unnecessary. They argue that expanding enterprise adoption, new agentic workflows, and emerging scientific computing demands are entirely sufficient to absorb the incoming capacity. The second